Well, if you're one of the lucky people with an overseas holiday in your near future, you'd be ecstatic about the rise and rise of the Australian dollar, which today peaked at $1.06 US. But the dollar's ascension isn't good news for everyone, and many Australian exporters are nervously asking how high is it going to go. One London hedge fund is predicting it could get up to $2 US, something that would undoubtedly lead to calls for Australian government intervention. John Taylor reports.
As the Australian dollar rises against the greenback, many people are coming to the same conclusion, that the time is right to holiday in America.
Good for travellers going over there.
I've been when it was 75 before, so I got a lot then, so I can get a lot more now.
American travellers, though, are experiencing what life is like on the other side of the currency seesaw.
My daughter lives here, and so I come quite often. And we used to give them money and it would be worth a lot more, and now it's not.
A decade ago, the Australian dollar plummeted to 47.75 US cents. Now it's shining, trading at a near record high, driven by a falling US dollar, Australia's booming minerals trade and high interest rates compared to other countries. But with gain comes pain.
Look, I think the rising Aussie dollar is having a punishing impact, particularly on the manufacturing sector, and is coming on top of a range of other pressures.
Made in Australia looks shaky with a high Aussie dollar. Export-focused industries are obviously challenged by a higher currency, and then there's increased competition at home from cheaper imports. Heather RIDOUT from the Business Advocate, the Australian Industry Group, says just over the past year, the dollar has risen about 18% above its average against the greenback.
But it's whether it stays at those levels for a protracted period that will really sort it out. Most seem to suggest it will, and if that happens, I am very concerned about the future of industry, because it just erodes its competitiveness both here, domestically against imports, and in export markets.
Each budget.
Australia's new Treasury Secretary, Dr Martin Parkinson, yesterday told economists in Sydney, get used to a high dollar.
Our dollar, which is currently close to record levels, can be expected to move roughly in line with the terms of trade over the longer term. It's therefore expected to also remain persistently high.
Terms of trade means the ratio of the prices of exports to imports. And Australia's terms are currently at 140-year highs. Dr Parkinson says a sustained increase in the terms of trade and a persistently high exchange rate is not just a temporary shock, but part of a reshaping of the Australian economy, driven by the rise of India and China.
Most Australian businesses are well equipped to deal with short-term volatility, but what we're dealing with now is a very different type of event. Not a temporary appreciation, but a sustained shift in the exchange rate. And this will challenge a number of existing business models.
In the wool sheds of Australia, farmers are enjoying a surging wool price driven by high demand and a shrunken national flock. Australia exports about 60% of what farmers produce. The National Farmers Federation says a rising dollar is bad for the bush.
What we do know is that for every 1% increase in the Australian dollar, that shaves just over $200 million off net farm income.
And what of that other pillar of the economy, mining? One senior resources analyst says right now things are good, with strong demand and more investment locked in.
Deciding points are going to be whether it's just the Australian dollar that continues to rise, or whether the currencies of other mineral exporting countries, such as Brazil, Russia, if they also rise, then it's a bit of a zero-sum game and we're not greatly disadvantaged. But if for some reason the Australian dollar rises a lot more than those other minerals producing countries, then we do really have a serious challenge, and it could threaten investment long term.
But right now the dollar is going up, and the question now confronting many in Australia is just how high is it going to go?
How long's a piece of string? Look, I think the Aussie dollar is going to get to around 112 to 114 over the next few months. And that's going to be because the Australian Reserve Bank is raising interest rates, whereas the US Central Bank is going to keep rates near zero for most of the rest of the year.
By 2014, at the very latest, I'm convinced that 1.7 is more than credible. Even that is probably conservative. You have been at 1.5 if you go back to the mid-1970s. In terms of where it could go to, ultimately, it could quite easily breach $2 US dollars.
Dr Sava Savori is chief economist and partner at the hedge fund Tosca Fund, which he says manages about $2.5 billion US dollars worth of assets. Way out from the pack, he believes the Aussie dollar is going to soar.
I'm convinced that it's undervalued. I'm convinced it's underinvested. I'm convinced that amongst the economies in the G20, the Aussie dollar will be the most spectacular performer. It is a currency, quite frankly, that has every box ticked. And if you can show me a better currency, I'll be surprised.
Even though Australia accounts for only 1% of the global economy, the dollar is the fourth most traded in the world. Some call it a casino currency, fuelled by speculators. And if it keeps on rising, there are mixed views on whether Australian authorities might try to stop the action.
We can show the Australian economy is always changing. There are always new jobs and businesses being created as new opportunities are identified.
I don't think the Australian government or the Reserve Bank has been making any moves to strengthen the dollar. Both the government and the Reserve Bank have a very much hands-off policy when it comes to the dollar.
It will necessitate action from the government because there will be potentially a lot of restructuring that will end up in job losses. And I think the government are quite conscious of this. They spent a lot of time talking about it in the budget and in the discussion around the budget. And I think, the pain will start to hit and in the next 6 months or so, if not before. And I think it definitely will necessitate government addressing this issue.
John Taylor reporting.